to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and Independent Advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to yet another instalment of our Nucleus Insight series. And today we're looking at all things ethical. So we've decided to call this one Ethical Impacts on Your Bottom Line. So we'll be running through ethics in general and some investment themes and also answering a few questions that have come up in the last little while, given our recent spate of good performance and some questions around how people's portfolios have differed from our stated figures and reasons why, typically to do with ethics as well. So jumping into it, we've got our agenda today. We're going to start by just doing some rough definitions of what ethics are in the investment world. What does investing ethically mean to a portfolio's performance? Some positive and negative impacts that can occur through choosing different ethical screens and deciding to invest ethically. And then finally, what are some options for someone wanting to invest in an ethical manner, and a number of different examples and products that are out there, and a little bit of a reflection on that as well. So let's jump into it. We'll kick off with some definitions, and welcome to you, Damien.
Thanks, Jim.
There you go, mic's on.
Sorry, thanks, Tim.
Very good. So I guess we've got a slide up there, and we're pretty slide light this time, this webinar, which is great for those podcast listeners. But I guess broadly speaking, the investment or the state of ethical investment can roam through a number of different what would you say, grades, for want of a better word. And I know a friend of mine who works in the ethical investing space does quite often class investors as light green and dark green investors. So I've sort of tried to relate that through to here. We'll kick off with sustainable investments.
Yeah, so sustainable is, I guess what it's looking at is the spectrum across from sustainable, socially responsible investing through to the sort of darkest green, the ethical investing. And so I think the sustainable is more looking at companies and choosing on sort of environmental, social and corporate governance factors, and not so much on what the company actually sells itself. Socially responsible then sort of takes the next stage where you start screening out stocks where if they take part in excluded activities. But you can sometimes include companies where the positives sort of outweigh the negatives. And then finally, you get the darkest green, where you look at negatively screening stocks and not including them in portfolios if they make or sell certain products, and then positively screening stocks which sort of suit your ethical bent.
Okay, sure thing, and we'll cover off on what positive and negative screening are a little bit later on in the webinar, but that's a great place to start. So then moving into another common, acronym in the ethical parlance, ESG.
ESG, yeah. So that's standing for environmental, social and governance. So environmental is a little bit self-explanatory. So you're looking at waste and pollution and things like that. Your social side then looks more at employees, suppliers, how it fits into the communities that it produces, and things like safety and that type of thing.
Okay.
And then finally, the governance is more about the how the company's leadership, executive pay, audits, internal controls, and those types of things. So so three sort of different facets that sort of come into what most people think of as ethical investing.
Okay, sure. And I guess, and we'll touch on this a little bit later, but obviously there's some social and governance impacts that are pretty top of mind at the moment given the Australian financial sector.
Absolutely. And so that comes back to, AMP is obviously going through a pretty tough time at the moment.
Sure.
And the questions about, whether there's criminal charges coming against people. There's been calls for breaking companies up and things like that. So this is probably, I guess, an extreme example, but it does show that, in terms of governance and that overall, the overall attitude, I guess, that companies take to how they deal with their customers, and are these customers there as we're trying to do the best thing for our customers, or are these customers there as we're trying to make as much money as possible from this group of people? And that sort of comes, so obviously trying to make as much money as possible from a group of people can be very, very profitable for companies and can look really, really good for years and years and years. But, there's that sort of sting in the tail is if you get it, you take a step too far, and next thing the companies are being broken up or big fines for shareholders and things like that. And
I guess just as a bit of a comment on some of the financial sort of misdoings and misgivings that have come out in the Royal Commission, an interesting piece there, of course, being that the company's presentation to the media and to the public, and then when the curtain gets raised, it can be a little bit different.
Yeah, absolutely. And look, I mean, everyone puts spin on it, and especially in I think as an investment professional, every time you look at something the company's put out, it's always about, I know you've probably put a good spin on this, and how do I bring it back to what really happened? But yeah, there's obviously some relatively damning things that have come out in terms of I think the independent report is obviously is something a lot of people lean back on. It's not just companies. I think a lot of governments lean back on this. We've commissioned an independent report.
Sure.
But more and more as we've seen is that those independent reports are often covered by a thin veneer, and the person who's done it has been paid a decent fee. Usually might be probably at least $20,000, could be hundreds of thousands for producing big reports, and they know those people like to point out what's happening, but they know which side of their bread is buttered, and if you come out with something that's too damning, then you can kiss goodbye to your next gig, $100,000 report to write. So
it's a cynical start to our definitions, but anyway, yes, David, how are you going?
Good, thanks, Tim. It's probably not all that directly related to ethical investing, but just to note quickly that that paid report business has become a huge sort of infection inside economics itself.
Okay.
Where and the political economy for that matter, where you have a bunch of sort of data houses that really just make money by doing these reports for companies with preordained results, and they just tweak their models this way or that to get the result that they want. So sort of garbage in, garbage out kind of problem that is now very widely used.
Okay, sure thing. Thanks for that, David. Okay, so look, obviously a number of different criteria for assessing the I guess where a company sits on the ethical spectrum, and I guess from here then it's really down to where does the investor draw the line personally, and how does that sort of transpose in a physical sense to the way they invest. So I guess we've put a couple of things up there, a couple of key issues to consider for someone looking to embark in relating their ethical bent and beliefs into their portfolios. Do you want to just run us through those, Damien?
Yeah, so three key things I want to focus on is the first one, the biggest one is the effect on investment performance. Now that's because if you're sitting at the supermarket and you're saying, okay, do I buy free range eggs or do I buy cage eggs? You can look and you can pretty directly compare the two prices.
Sure.
Investment performance is the hard one for ethical. And the most frequent question we get is I think a lot of people will look at that case and they'll go, okay, well, if the eggs are 20% more expensive, then I'll do it. If they're 300% more expensive, then I won't. Or everyone will have their limit as to what it is. And the hard thing with the investment side is nobody has a good answer for it. So we've got a number of answers, and I think that it's very confusing, and the people selling the products often make it. If you're selling an ethical fund, you will make it a bit more confusing as well.
Okay, sure. And then stepping into the next issue.
Next one is So the first one, investment performance. The next one is how you're choosing stocks. There's a number of different ways you can go about choosing it, whether it's positive screens, negative screens. And we'll go into a few of those different ones. Okay. And the last one is the fees side of it. I've got my views on that, but I think the biggest one is that I think in my experience there are some ethical funds that are charging fees that I wouldn't consider to be ethical in terms of the size of the fees for what they're actually doing. Okay. So I guess that's sort of coming full circle is saying, well, you need to work out what you're paying for, and if it's just knocking a few stocks out, then do you need to pay an extra 1.5% per annum just for somebody to knock a few stocks out for you? Okay, say no more. All right, we'll jump into that one in that section, but we'll kick off with the ethical effect on performance. And I guess there's a pro and a con for mine anyway in the fact that there has been a resurgence or an emergence perhaps of demand for ethical investing, and that's of course then been given fertile soil to a number of different ethical funds and managers going out there and saying, okay, well, this is what the public wants, so I'll create it. And then to me, that would then lend itself to say, well, okay, if people are looking to invest more ethically, would that naturally then flow into higher prices for companies that are either doing ethical things or as opposed to that perhaps not being part of the typical ethical sort of things that people wanting to avoid, fossil fuels and nuclear and arms, etc. Yeah. So I guess from as a sort of a big picture perspective, there's a supply demand thing, and so if the companies that are if you have two companies that are going to perform economically exactly the same for the next 20 years, sure, and you can buy one of them on a price to earnings ratio, or let's say dividend yield even, let's bring it back one step further, if you can buy one on a dividend yield of 5% and the other one on a dividend yield of 2%, yep, but you're going to get the same growth in actual dividends the whole time, then you're better off in the one paying the 5%. That makes sense. And so it's if that means if what you're finding is that the companies that are ethically challenged and they're trading at a much cheaper price, then they probably will give you better performance. That's that whole sin stock. Maybe I should chase out the sin stocks. Okay. The flip side is there are a lot of things that some of these companies do that are unethical, and every now and again they get caught out, or they're in an industry and they're burning their customers, and it looks great for a few quarters, but if you keep burning your customers, eventually you start running out of customers, or word of mouth gets out, and so it is a matter of trying to walk that line about are they destroying their actual base, or are they being biased against and going from there? Okay, yeah. And I guess the other side, and I guess probably more so from an investment management point of view, in that second line there, in having obviously the idea of that if you've got a set, if you've got stocks, yeah. So if you've got a universe that's, within ours it's 1,700 stocks, and then obviously you knock out half of them due to a lot of ethical screens. Yeah. So actually, what I wanted to do as well is CanStar had something out sort of last year. They've come out with one of their things was, do responsible investment funds perform as well? And they sort of came out and said yes, they do, and they often perform better. Okay. Now, for me, that's wrong. I guess it's possible for ethical funds to outperform, and it will happen over certain periods, and we've got a few examples of it. But I think as a big picture idea, as a manager, if I've given 1,600 stocks, which is the world index, and said go out and find the best stocks and try and perform, and then if somebody says, well, now I'd like to cut that 1,600 back to 800 stocks because I'm cutting out all these ethically challenged stocks, yep, now go and beat the guy who can invest in any 1,600, over the long term, you're probably going to lose out. You've pretty much got one hand tied behind your back. Exactly. Okay, sure. So you've got fewer stocks. But that doesn't mean that you don't go through periods where where you do get outperformance. So, for example, I've got a chart up of just the oil and gas stocks now.
Okay. Yep. So we've got there the world return substantially higher.
Yeah, that's right.
And
so this hasn't got the last sort of 6 months or so as the oil price has recovered, but we went through this period where the oil price fell from $100 back to 30 and then sort of recovered a bit. But what that meant was all the oil companies got smashed. And so if you were in a fund which was carbon, which had a carbon as one of its as one of the screening factors, you probably outperformed, not because your investment managers were geniuses, but because they literally weren't allowed to buy the sector of the market which was one of the largest sectors of the market which fell by the most over that time period.
Yep, that makes sense.
So, and that's where I think a lot of the recent bit has come, is that there's these funds that are anti-carbon and they've performed really, really well. And now people are saying, oh, maybe ethical funds can outperform over the longer term. And they're saying, well, no, you've got to pick your period.
Yeah.
Because a lot of those have then given it all back over the last couple of months as the oil prices rallied.
Okay, sure thing. David?
I just want to pose you a question there, Damien, which is specifically on the carbon and oil and gas outperformance. I mean, to some extent, this cyclical dip that we've seen has been the result of the decarbonisation process globally, with Saudi Arabia mulling whether or not to get it out of the ground fast or leave it there, etc. So where do you see oil and gas going in terms of the longer term as decarbonisation accelerates, and how would that play into your ethical thinking?
Yeah, this one's obviously an issue where there's fundamentally a big change happening at the economic level as well. So for me, the big thing is is solar power, and that, I could spend a lot of time on this solar and wind power as well, in that the level of these technologies, the cost of these technologies was significantly above average, above what it was for coal or for oil. But those levels have plummeted, and then now we have battery technology going through the same bit. And so for me, solar plus battery is a sort of killer app, and that's our upper bound for prices. And so I do see that oil and gas and coal, it's got a little bit of scope to increase with the shortages over the next little while, but it's got this upper bound of solar plus battery is you can't go above that. Because if you can replace, if the coal price tripled, then all of a sudden for everyone in Australia, it's worth having a solar panel plus paying up for a battery.
Yep.
And it sort of puts that cap, and that cap is coming down, consistently over time.
Okay. Yep. And okay, sorry, David. Yep.
So that raises the prospect of long-term outperformance for that, at least that ethical screen. But some argue as well that oil might actually get scarcity pricing as policy drives, high carbon businesses to the margin, which is kind of what we've seen, at least in the short term, on thermal coal, with China rationalising the market. What's your position on that?
Look, you'll absolutely go through periods where, and especially for commodities that cost a lot of money to get out of the ground and are big capex projects, where you can get caught short. I think for me, there's definitely some longer term uses for oil in particular that we don't have a solution to. In the shorter term, there's probably planes are probably a one where batteries just aren't light enough and probably take a fair while longer.
What about things like plastics and
exactly the plastics and the whole chemicals sort of complex? There's significant usage in that, and so it's still going to be needed. And so there is an argument that maybe these will be higher, but I think though as well that argument comes back to there's a lot of people out there producing already, and if they're starting that if it's demand and supply, the net demand and supply is very small on the end, and it could be swung around a lot. So if you've got a lot of suppliers out there and the demand falls away quite sharply, then the price is going to plummet. You probably might hit a stage where there's not enough investment, and then the prices do need to rise. But then it's a question of, can the demand for plastics, and if the price of plastics is that maybe artificially lower than it should be because everyone needs petrol for cars, and you get to
And that's the
filter some of it
primary
off.
driver of the prices.
Yeah. So I guess I think the carbonisation one is probably a little bit confusing insofar as I actually agree with the longer term trends that are taking it out of it, and I think there is an investment case against it. But if the oil price was $10, then I'd probably be saying, well, there's still a big need for a certain amount, and there's opportunity
there.
Opportunity, and looking at demand and supply and things like that. So I think for a lot of these, it all comes back to price in the end. For most of them is working out what is the right price for these
sure
assets.
thing. All right. Well, look, thanks for that. We'll jump over to another example we've got, which is on the flip side, really, I guess, being the tobacco stocks. So we've got a graph just up on for those listening in where it shows tobacco well and truly taking off against the world index there.
Yeah.
And this was actually this came up as a question from one of our clients who was ex-tobacco and didn't want to had the tobacco screen on, and there was a question around the performance when we had a bit of a look. It was this is one of the primary drivers for the difference.
Yeah, that's right. So I think there's a lot of funds which are ex-tobacco. It's quite a common one in some of the institutional funds. So basically we can invest in anything around the world except for tobacco stocks, and often they have cluster munitions as well. Is quite a common one.
Sure.
And so tobacco stocks had a great 10 years or so. They the last 6 months, 12 months hasn't been as good. But if you were in an ex-tobacco fund, then quite likely you underperformed. So if you're in the ex-carbon one, you've outperformed. You're in the ex-tobacco one, you've underperformed, and that's partly that thing I was saying. The prices were quite low, and these guys were selling a lot to emerging markets, and that's a growth. There's a growth area, and,
sure.
and as they get richer, they can afford to buy whole packets rather than buying cigarettes by the individual cigarette, and so it is a bit of a growth market, and so I guess what I'm trying to pose to people is saying, okay, performance on aggregate over the long term is going to be negative, but if there's large sectors and you're excluding large sectors, then you are at the whims of whether that sector goes up or that sector goes down.
And I guess ultimately from an investor's point of view, it's really about being comfortable with the potential negative impact. That's effectively the impact of sitting out of those or not supporting or not participating in your money being involved in those areas.
Exactly, and so the questions are, how big is that impact? And we'll move on to that shortly.
Sure. Yep. And so finally we've got a one on. Sorry, not finally, but we've got one on corporate governance being an exception. So maybe just talk us through a bit of we've got some examples there of some corporate governance as well.
So if you look quantitatively at the stocks and you say, there's a number of things for corporate governance that tend to do well, whether it be having independent boards or having shareholding structures that are there for all shareholders, not just certain shareholders, and so and quantitatively, companies with good corporate governance do tend to outperform those with bad
corporate governance in the long term. Well, that makes sense, I guess. Yeah.
And so a lot of funds and myself in particular like to incorporate that into your investment process, of saying, okay, well, if I can find companies that have good corporate governance, then I'm more likely to buy those stocks than the ones without.
Sure.
But there are a lot of grey areas in here. So, for example, you have Alphabet is got some non-voting shares,
which is Google for those
Google,
at home.
Yep. So Google's got some non-voting shares, that's a no-no, in that basically you're saying here's one class of shareholders that we're giving lots of votes to, and here's another class of shareholders we're not giving any votes to.
Okay.
On the flip side, they've got a large, well-diversified board, so which is mainly non-independent.
Okay.
And so then there's pros and cons. Which one's better? Which one's worse? Does having a good board offset some of these other ones, and so there's lots of those questions. There's no real clear answer to, but it is clear that we've seen some issues with AMP, we've seen some issues with CBA. Even Facebook's had a few issues.
And it was quite interesting. Obviously, Facebook got kicked out of an ethical ETF. We cover off on a little bit later. I guess this is one of the things when new news comes to the front that the company should be keen. And the flip side is that if Facebook's had a pretty good run, and now being ex-Facebook may be of benefit to the fund itself as well. Quite timely, perhaps.
Yeah. So I guess it's the tail risk you need to be is the key thing you need to be aware of in this. And there are lots of caveats. As I said, there's lots of cases where shareholders with massive, one or two shareholders with lots of control and lots of, structures that are all beneficial to them, and everyone else is along for the ride and they actually happen to do quite well. But on aggregate, you want good corporate governance in the companies you're buying.
And yep, fantastic. And just finally as well, just as a cheeky side note, I remember AMP last year did a big run through their an ethical screen through a lot of their portfolios in about March of last year from memory. And now it's probably a chance that everyone else is going to be doing a run on AMP through their portfolios on ethical basis. So anyway, we'll move on though. So I guess just capping off the effect on performance. What in an overall perspective? Let's have a chat around that.
So what are we talking about? Look, it depends on how much you want to cut out, and depends on how good you think investment managers actually are at picking stocks. If some people are of the view that, look, nobody can do this, the whole market's efficient, you should just buy an index fund and forget about it.
Sure.
Well, if that's the case, then there's less of an effect.
Okay.
So you're not giving up much by being ethical because no one can pick anything anyway. If you do have a view that investment managers do have some skill and they can choose between it, and you knock out, say, 10 to 20% of stocks, then you're probably talking about 0.5% in the long term.
Okay.
And that's sort of that's running sort of Monte Carlo simulations and things like that.
Sure.
Which doesn't account for
oil,
the oil sector,
tobacco
underperforming or tobacco.
Something.
Yeah, that's right.
Okay.
And so, I think in the best case, you try and get a bit of both in that you are trying to take a bit of a pick on some of these sectors, but also you've got an eye to some of the ethical side.
Okay, sure thing. Yeah. All right, very good. And so just sort of we might just dive into from a management and a portfolio management point of view some the nitty gritty on exactly how ethical options and themes are pushed into or enacted in portfolios. So we'll run through three of the usual methods.
Yeah, so the three most common is positive screening, negative screening, and then what I call best of breed products. So if you're in a, I guess the first step I'd like to say is if you take a step back and say, well, why do you want to be an ethical investor? Because I think a lot of people have the feeling they would like to be, but I don't think have really thought through the reasoning why. Mm-hmm. Because for me, my take is that there are a number of different ways you can use your money to help. One is you can just make a donation to people. So if you've got a fund, companies themselves aren't tax deductible generally.
Okay.
But if you're trying to find an ethical one, there will be an industry body or there'll be something that's, you can just give your money and take a tax deduction straight away.
Okay, sure.
So rather than sort of sticking your money in a company that might might be great on paper, and I'm a bit of a sucker as well for some of these ones where you look at a biotech and they're going to cure cancer and they're going to save all these poor kids, and then and I'm going to be a millionaire on the back of it as well. Win. But the reality is most of those they're not priced on the actual investment fundamentals. They're priced on the whole emotion of I can buy this stock and I can
support the
help
cause.
Support.
Yep, sure.
Whereas most of those there's plenty of cancer foundations. There's plenty of things like that where you can. Rather than sticking $10,000 into this stock and seeing it gradually whittle away to nothing over a course of 10 years as they spend all this R&D, you could give the $10,000 straight to
the source,
straight to the source
and help them out rather than buy it off
and
somebody
take a tax
else.
deduction straight away rather than waiting for 10 years to write it off.
Okay, sure.
The other thing you can do is you can buy the product yourself. That's all. Most companies would prefer to have more customers rather than more shareholders.
Okay.
And the companies that don't. The companies want more shareholders and customers. You don't want to be investing in. They're the Ponzi schemes.
Sure.
So if you let's say it's solar power, for example, and you want to support it, well, buy yourself a solar panel or help get one for your schools or do whatever it is on that front is much more helpful than buying a share, especially from another shareholder.
Yep.
So that's sort of my bottom one. So the first thing is sort of make a donation if you want to help. Second thing is buy the product yourself. Third thing is buy your shares in a capital raising, because if I'm buying my shares from another shareholder, I'm doing nothing for that company. It's all it is if I bought a share from you, Tim, I'm giving you $10,000, you're taking $10,000 and going away and doing whatever.
Yep.
The company itself doesn't really care whether I own the shares or you own the shares. It's done nothing for it.
Yep.
If it's a capital raising where they're saying, oh, well, look, we're going to start a new whatever, we're starting an R&D project, or we're starting a new solar farm somewhere, or whatever it is, and we need people to put money in, then you can make a difference by putting that capital in, especially if they couldn't have otherwise raised it.
Sure. Okay.
But But buying shares on the market from another investor is pretty much the
zero-sum game for the
company involved.
Yep.
Yeah, maybe there's a slight increase in the share price, but really you're not doing a lot for the overall factor. So I guess that's what my take is that decide what you're doing, why you're doing it for in the first place,
and then what impact you want to have.
Yeah,
sort of thing.
And so the three types, actually, just to come back then. So the three types you can do. So there's positive screening, whereas where you try and find companies that are going to outperform.
Okay.
And that sort of fit your criteria for ethics, and these are very, very difficult. So not only it's hard enough to go out there and say I want to find stocks that are good quality and cheap and are going to go up in price and all that type of stuff, and now you say plus they must be saving the world or adding to a good cause or something like that. And the number of stocks you can find that sit in that category are very, very few. And
highly concentrated, no doubt.
Yeah, that's right. And when you do, they're usually quite expensive, and
Sure.
so it's a tough one. And I think those ones are where if you think managers have skill, there's probably the lowest investment performance going to come from those ones.
Okay, sure. So, and negative screening?
Negative screening is then where you cut stocks out. So you go through certain sectors and you say these are the ones these are the sectors we don't like, and let's cut out those stocks because we don't want to. Yeah.
And that's essentially what we do at Nucleus Wealth. So
Yeah.
we start with a big portfolio, the best portfolio that we can, and then allow.
We'll let people cut out their own stocks.
Okay,
yeah.
sure.
Because that's the issue. The big issue with negative screening when you're choosing funds is making sure you've got a fund that actually aligns to what you want. So you might have a feeling that, look, alcohol's fine, tobacco's fine, gambling is fine, but I don't like the carbon and I don't like nuclear and I don't like the war.
Yep.
But the funds cut everything out. And so you're missing out on performance you might have otherwise got from some of these other places because you're in a big ethical fund and they've just got to go
Make
with
compromises.
Yeah,
Yep.
that's right.
Okay, sure.
And so basically you have to find somebody who's got the same ethics as you, or find a fund that's got exactly the same ethics as you, and then take that, or you're going to get underperformance from excluding sectors that you might think are fine.
Okay, sure.
And
the best of breed?
And the best of breed is where people, what they do is they look through all the stocks, they try and rank within sectors. So they'll look at, say, oil and gas, and they'll say, okay, we know there's the worst ones, which are the brown coal or the Canadian tar sands, so we're definitely not going to invest in those. But then there's some oil ones sort of sitting in the middle, and then we've got these gas producers at the end. So let's go and buy the gas producers because they're not
the green CO2 guys.
Exactly. And that's where so look, it's good you're doing that, and it's certainly making some difference. But I think from a big picture perspective, there's a lot of people who will look at those and go, well, I didn't want any, or if I'm investing in tobacco stocks, the fact I picked the one that tries not to sell to kids and third world countries rather than the ones that do, they're still selling.
Yep, still the same.
Still selling tobacco.
Yeah, sure.
So it's about getting that best of breed. There's managers like that because it means they can still invest in the sectors and not sort of lose out.
Yep.
But I think if your goal is to make a big difference, then best of breed for me doesn't make a lot of sense.
And you would sort of expect that a best of breed approach would potentially be more expensive as a method of management due to the fact that there's this added analysis layer, and then there's the ranking, and then there's the selection process and everything as well.
Yeah, you would have to. Often I think. Often managers will outsource a lot of the ethical side. Is the other thing?
Okay.
Like there is a lot of where the managers are like, look, I'm here to invest in stocks. You tell me what I'm allowed to invest in, and then I'll go and find the best ones in that universe. And so often that part is actually outsourced, but there is there's usually an additional cost on top of that to buy the, as you said.
Okay, sure. So, and that leads us nicely into fees. Just to wrap up our little section here. So.
Yeah, sure. So. So I think I probably preempted this in a way. Basically, look, the issue is that there are slightly higher costs to running an ethical fund in terms, as you said, you do need to do some more screens and things like that. But we're not talking sheep stations.
Sure.
It isn't a huge additional layer, and for a lot of managers, it really is just saying, well, I could invest in 1,600 now. I can only invest in 1,200. There's possibly even some cost savings there. There's not as many stocks for me to look at. I don't need as many analysts, or I don't need to get as much research.
Yep.
So I think you should be talking similar fees, maybe there's maybe in some cases if you're doing best of breeds or things like that, maybe there's justification for a little bit of an extra fee.
Yep.
But I think there shouldn't be
overpaying essentially.
Yeah, that's right, and it does. That's one of the things that very much irks me is when I look at these things and here's somebody selling an ethical fund and they're charging 2.5% to investors, and you're sort of looking at that saying, just a minute, we want everyone else to be ethical except for us.
Yeah, that's right.
as a manager, and so
going to greenwash you and greenwash your wallet as well potentially.
Yeah, exactly.
All right, very good. So we'll roll into a couple of different options now. I guess so from a practical sense. Obviously, there's has been around for a while now. A number of managed funds. A couple of names there: Australian Ethical, Perpetual, BT. Uniting Church also run a managed fund, which was interesting. Then, I guess, from a cost perspective, moving down to through to listed investment companies. There's a couple there, Australia-based Hunter Hall. Oh no, there's no Hunter Hall anymore. Morphic. Actually, there is. I think there's still a Hunter Hall, isn't there? Ethical? Not sure. I'll have to go and double check that one.
Yeah,
might have been an old page I was reading.
Gone.
Yeah, sure. And then finally, of course, the new vogue of exchange traded funds, offering I guess once again a broad palette of ethical themes, with that index sort of costing as well, which makes it a little bit more palatable from a cost perspective. I've got an example there of the beta shares ones, just speaking of the broader theme. So, and this sort of harks back to what you were saying before, Damien, in the sense that the cheaper, broader options are exactly that, aren't they? They give you a broad screening or broad, thematic taste, which then, of course, can work against you if you're ambivalent about a number of things that are actually contained inside of that.
Yeah, absolutely. And there might be ones as well where you look at, we have a number of different scales, but for example, you might look at the war side of it and say, well, look, I don't want to buy the defence contractors or people that are out, making landmines or cluster munitions and things like that.
Yep.
But I'm actually happy to own Boeing as an example. And so, there is that range of saying, well, where do they sit in terms of the scale of it? Or in terms of carbon, do I want no carbon, or actually do I just really want to get rid of the worst carbon ones?
Sure.
And so it's that type of thing about you're getting the works.
Yep, getting a bit of granularity in your sort of ethical, your internal ethics potentially. Yep, sure. And then from a thematic option, we've got essentially, one place to look is then there are a number of these available in the Australian market in the in a face-to-face sort of advice environment where they create essentially a bespoke and tailored, do you like this stock versus that stock? Obviously, it's laborious, but you're going to, a properly tailored, portfolio to yourself. But of course, this then comes with the added costs. You might be looking at, another % or two for the ethical advice, and then obviously on an ongoing basis.
If you had your own advisor, is what you're talking about.
Well, this is right.
Through a stockbroker or a financial planner who specialises in that.
Absolutely,
in that area.
That's right. Yeah, sure. And and look, that's certainly out there for people. And I guess the flip side of that, from a cost perspective, is sort of essentially where we sit in the separately managed account area, where we, as we've mentioned, we use the negative screening. So we build the best possible portfolio that we can for everybody, and then they can go in and remove those various ethical themes and beliefs. And there's an example there of some of ours. We've got 19 ethical screens at the moment, and a couple of portfolio tweaks as well for those who don't have any faith in the Australian banks. There's one that we've added in recently. Not so much perhaps an ethical theme, but probably a fairly topical theme.
Could easily be an ethical screen following the Royal Commission.
That's right. Yeah. Absolutely. So, but as you mentioned before, Damien, particularly the climate change one, it has got that I guess tiered effect of having high impact and broad, and then looking at coal seam gas, and we've even got one in there for the old growth forest loggers as well, which is surprisingly popular amongst our investors. So we're going to have more on that later when we talk a little bit more about Nucleus Wealth. I guess the other, we'll just in summation, the broader thematic options. So, overall, Damien, as an investor who wants to, who believes in certain things, has certain ethical sort of beliefs that they want to transpose into their portfolio and the way their money's managed, what would you sort of say? What are the sort of key things they need to think about?
Yeah, so key things is you need to think about performance. As I said, if you're cutting out sort of 20% ish of your stocks, you're probably talking about a 0.5% hit to your performance in the very long term.
Okay.
Which I think for a lot of people is palatable, as long as you're not also paying 2.5% in fees. If you're only paying 1% fees, and
Yep.
it all ends up being about right.
Well, and that kind of makes sense, because if you know that you're already going to potentially have an impact on your performance, then having doubling up or tripling up again on your costs is just going to work even further against you, isn't it?
Absolutely.
Yeah, sure.
Yeah. And then I think you need to come back to decide, really, given that thought that the more sectors I cut out, the worse my performance will be. Because if you're only cutting out 5% of stocks or something like that, which I think for a lot of people these ones will, then you're probably talking you're decimal places. You're rounding. If you're looking at if you're giving a universe of 1,600 or giving somebody a universe of 1,550 stocks, look, there's going to be, you're not going to be able to tell the difference in the performance, and it may well be positive.
Okay.
For if you're only just making very small changes.
And as mentioned before, there is the potential of, say, with the fossil fuels, that if predictions are correct in the sense that we slowly wean ourselves off the off oil, as it were, as a broader transport method, at least for energy usage, then you might see some positive push, some good tailwind.
And though, I guess I don't want to open that too far, but it is worth thinking about thoughts about saying, with the oil price at $75, I've got the negative view on that.
Sure.
Subject to political pressures that could push it higher. But, if the oil price was $5 or $10, then I'd probably be in there buying these stocks. And it's a question of if you've got an ethical bent or if you've got an investment bent. So there's sort of, you got to keep those two separately in terms of saying if you have an ethical bent that I don't care if it's $5 or if it's $2 for oil, I don't want any of it in my portfolio because I want to I want to help the transition across.
Yep.
Then tick the box and cut them out. Whereas if it's just an investment side, then you're chasing investment themes through trying to do an ethical. Might be the wrong way to do it.
Yeah. Okay.
I'm getting to.
Sure thing. All right. Very good. And now we'll just finish up with some information about Nucleus Wealth.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
So that concludes our webinar today on ethical investing. Our little deep dive into how we transact on and help people invest ethically on their
in their portfolios every day at Nucleus Wealth. Thanks, David and Damien. And coming up next week, of course, we have the focus on the future of financial advice. Obviously, a close and held quite interest, a high level of interest for myself as a financial advisor. We're going to have a little bit of a run through of the recent Royal Commission findings and also where we think financial advice is headed. So same bat time, same bat channel, the 24th of May, Thursday the 24th of May, at 12:30 p.m. And if you'd like to register your interest for that, head over to proton.nucleuswealth.com. Just a final reminder as well for those who don't know but we have started to release these webinars as podcasts, and you can get these at all major podcast vendors or listing apps. Podcast Addict is quite a handy one on Android, and obviously iTunes for anyone with an Apple. So feel free to head over there and check out our library. Finally, thanks very much for attending and listening in. I hope you got something out of it. I certainly did. And also, as always, for those that have lodged their interest on the Proton site read out below, there will be a survey sent around for you to give us some feedback on how we've gone today. And also, you can also offer up any topics for future webinars, and we're more than happy to do a bit of research and bring something to you. So on that note, thanks very much for listening, and we'll see you at the next one. Cheers.